Another strong inflation report Friday with promises of more to come. It does raise the question whether the Fed may have to do much more to get control of rising prices, not just taper faster or even raise rates earlier. Markets already have that priced in, but actually move to slow the economy. Here's a preview of tomorrow's Fed survey. We asked if the Fed eventually could have to raise rates above neutral and slow the economy. 45% of respondents say yes, 48% say no, so it's an issue that's out there. Rapid changes in the Fed's own policy outlook mean that most forecasters only now catching up to where the market's priced. They have brought forward their estimate of the first rate hike into the spring or early summer. But is that enough given the current inflation outlook? J.P. Morgan's Mike Ferroli writing over the weekend, while market pricing incorporates an early Fed start, it's not anticipating the cumulative adjustment that lies ahead. We forecast policy rates to rise 175 basis points by the end of 2023 and see Fed forecast projecting a return to a neutral stance, 2.5% in 2024. Fed futures market is priced in a May rate hike, just about a second hike in September, and a third one coming in December. That would put the funds rate just about 88 basis points at the end of next year. Investors, they're going to watch the Fed's own new projections. They're going to come out on Wednesday to see how aggressively the Fed itself forecasts the path for the funds rate. The real Fed funds rate, take out inflation, minus 6.8%. That's the lowest on record, lower than it was under Volcker. The Fed has a lot of work to do to get to neutral. Question is whether markets have priced in that level of tightening, Andrew.
Steve, stay exactly where you are because I want you to be part of this conversation. Joining us right now is Allianz and Gramercy advisor Mohamed El-Erian. He's also, of course, the president of Queen's College, Cambridge. Good morning to you. Why don't you try to answer the question, if you could, that Steve just raised, which is effectively, do investors have it right or not at the moment?
So I think the fixed income part of the investment universe has it pretty right. Has it right not only in terms of pricing the rate increases, but also recognizing that there's a limit to how far the Fed could go. This economy cannot support higher rates quickly. The equity market is playing the liquidity paradigm, and they are right to do so. Even under Steve's scenario and under the market scenario, we have another 150 to 200 billion of liquidity injections ahead of us in the next few months. So I think there is this massive difference between the two markets, and it makes total sense.
Mohamed, I don't know if you heard, Steve and I were talking a little bit earlier about Kevin Warsh's piece in the Wall Street Journal this morning, and we don't need to relitigate whether it's all the Fed's fault, which is in large part of the thesis. But if you try to look forward in terms of how you think the Fed is going to think about this, not just how they will think about it, but how they should think about it, in terms of dealing with the stability of the financial system and the monetary system. How do you think they should do it?
So the way they should do it is recognize that they've been caught massively offsides, that they are late, that their inflation read was awful, and they have a credibility issue. And the reason why they got caught massively offside is they were functioning as if the problem is deficient aggregate demand. And it turns out that the problem is not on the demand side, it's on the supply side. So they are caught with the wrong paradigm. So that's reality. If I were them, I would do three things, which they will not do. I would, one, be very open and honest as to why I got the inflation call wrong and try to regain the inflation narrative. Two, I would go even further than doubling the rate of taper. And three, I would open it up to the possibility that rate hikes may come faster than what the market has. They're not going to do that. What they're going to do is double the rate of taper, not go beyond that. They're going to tell us that inflation is more persistent and higher. We know that. And then they're going to wrap all that up in the uncertainty packaging because of Omicron. Right. So they're going to stay behind and fall further behind, in fact.
Hey, Steve, is Jay Powell saying to himself, I got it wrong? Or is there somebody else on the board who's saying, hey, Jay, we didn't get this right?
Jay Powell basically said publicly he got it wrong. I mean, what do you make of that speech he made at the end of November where he said it's not transitory anymore? We're gonna taper early. Remember, the Fed made a decision beginning of November to do 15. He came back at the end of November and said we're doing 30. I'm not sure what else Fed Chair Powell has to do to say that he got that wrong or the Fed got it wrong. And why did he say that? Well, he said, among other things, we maybe need to get around to thinking about hiking rates sooner. So, yeah, they got that wrong. And they also got wrong the extent to which I think supply constraints were an issue, that it was, as Mohamed said, a supply side issue rather than a demand side issue. They were treating one problem and it was another. I want to get back to something Mohamed said, which is really interesting, which is playing the liquidity game for stock investors. And Mohamed can correct me if I put words in his mouth the wrong way, but there's two aspects to this. The first one is that the Fed is going to continue to buy for quite a while. That's one thing. That's what they call the flow argument. There's another argument called the stock argument, which is that the Fed's balance sheet has cranked up over the time that we've been hanging out here and talking about this from $4 to $9 trillion. Over the course of the next year at least, the Fed's balance sheet is going to remain $9 trillion. We ask a question, I'll bring you the answers tomorrow, about whether the Fed eventually is going to get to balance sheet reduction, but that's down the road. So for at least some foreseeable future here, we have inflows into the stock of how much the Fed has, and we have a huge stock of $9 trillion. All of that, I think, sets up a pretty decent environment for stocks until or if it gets spooked by the idea that the Fed may have to clamp down on the economy in order to get control of inflation.